This Week in Economics on the 11th of October 2015. Numbers Man here. We'll hit a few little topics today. We'll talk about the Group of 30 based upon a Reuters article. Let me get to the title of it. Can central banks, cavalry can no longer save the world? It's about the various central banks throughout the world. And we'll go to the Group of 30 and talk about who they are and some of their assumptions, forecasts, etc. But firstly, the Fed minutes have been released, and we'll take a brief look at the Fed minutes. We won't spend a lot of time on it, but this was released on the 8th of October. The Federal Reserve and the Federal Open Market Committee on Thursday released the attached minutes of the committee's meeting held on the 16th and 17th there. And let me go to it. I believe we're heading to, well, just a second here. We'll get that now. Thought we'd had it here. But nonetheless, a joint meeting of the Federal Open Market Committee and the Board of Governors was held in the offices of the Board of Governors at the Federal Reserve System in Washington, D.C. And it was a two-day affair, and everyone was there. With Janet Yellen there, Doug Lee is the vice chair, Charles Evans, Stanley Fischer, Dr. Fischer, Jerome Powell, etc. And there's some of the others here. We won't really go into them. But they had Simon Potter, manager of systems open market accounts. There were many people there. James Closure, Stephen Meyer, Deputy Division of Monetary Affairs of the Board of Governors. It's a very, very long list. But developments in financial markets, open market operations, and policy normalization. The manager of the open markets account reported on developments in domestic and foreign financial markets. The deputy followed with a brief on money market development, system open market operation conducted by the open market desk. You've probably heard Chair Yellen refer to that particular system. By unanimous vote, the committee ratified the desk's domestic transactions over the intermeeting period. There was no intervention operations in foreign currencies for the system accounts for the intermeeting period. Let me just get this. We don't want to jump by them. System open market accounts reinvestment policy. A staff briefing provided background on macroeconomic effects of ultimate approaches to ceasing reinvestment of principal on securities held by the SOMA. That's the the system open market account. After the committee began to normalize the stance of policy by increasing target range of the federal fund rates, the briefing presented analysis that was based on the assumption that the cessation of reinvestment, once implemented, would be permanent. The briefing suggests that if economic conditions evolve in line with a model outlook, differences in macroeconomic outlooks would be minor across the approaches that cease reinvestment soon after initial policy firming or continual reinvestment until certain levels of the federal fund rate, such as 1% or 2%, were reached. As a result, the appropriate path of federal fund rates would be only modestly affected. However, if substantial adverse market shocks occur, continual reinvestment until normalization of levels of the federal fund rate was well underway could help avoid situations that would warrant a larger reduction in the federal fund rates than perhaps could be accomplished given the constraints posed by the effective low bound to normal interest rates. Let me get this down here. In the ensuing discussions, participants considered the advantages and disadvantages of alternative approaches to reinvestment. Principals referred to the committee's statement of policy normalization principles and plans, which indicated that the timing of succession or phasing out of reinvestment would depend on how economic and financial conditions and the economic outlook revolved. Several participants emphasized that a continual reinvestment for some time after the initial policy firming could help manage potential risks, particularly by reducing the probability that the federal funds rate might return to effective low bound. Some participants expressed the view that, in contrast to the assumption in the staff analysis, the committee could choose to resume reinvestment if macroeconomic conditions warrant. Staff review of economic situation. This is very important. Suggests that real gross domestic product was expanding at a modest pace in the third quarter. Labor market conditions continue to improve, but labor compensation gains were modest. Consumer inflation remains below the committee's long-run objective. That's 2%. Was restrained by further declines in energy prices, non-energy import prices. Survey measures of long-run inflation expectation remain stable, while market-based measurements of inflation compensation move lower. Total non-farm payroll employment expanded to a solid pace in June and August. The unemployment rate stayed at 5.3% in July, but fell to 5.1% in August, with the labor participation rate unchanged over this period. The employment to population ratio edged up. The share of workers employed part-time for economic reasons remained elevated. The rate of private sector job openings increased in July and was at the highest level, while the rate of hiring and quits were little changed. That's one thing they look at. Industrial production on balance during July and August. Manufacturing fell in August primarily because of a large drop in output of motor vehicles and parts that reversed a substantial portion of its jump in July. Automobile makers schedule further declines in assembly over the remaining period of the year. Broad indicators of manufacturing production include reading of new orders from national and regional manufacturing surveys suggest that factory output would be little changed over that period. Mining output moved up on net in July and August after steep declines in Q2. Real personal expenditure, that's PCE, appears to be rising at a modest pace. The component of normal retail sales used by the Bureau of Economic Analysis to construct its estimate of PCE increased at a strong rate in July and August. Sales of light motor vehicles moved up both months. Household spending was supported by modest growth in real disposable income in July. Wealth-to-income ratio that remains high even after recent declines in equity values. Consumer sentiment, this is the Michigan Survey of Consumer Sentiment, declined in early September, reportedly in part because of recent decline in stock market prices, but it remains above last year's level. Activity in the housing sector remained on a gradual upward trend. Starts of new single-family homes rose early in the third quarter and was slightly above the pace of permits issued. In the multifamily sector, starts fell back after having been temporarily elevated in June. Sales of new and existing homes increased in July, and this is a period that most of the real estate activity is spring and summer in terms of selling. Real private expenditures for business equipment and intellectual property products appeared to be rising moderately. Standard shipments of non-defense capital goods, excluding aircrafts, increased in July. Orders for non-defense capital goods pointed to modest gains in shipments in the coming months. Total government real purchases appear to be declining slightly in the third quarter. Now, a lot of this will be affected in December in terms of the budget and the debt ceiling. So these are things that obviously the Fed has to look at that have not yet occurred. Let's see. State and local government purchases seem to be increasing on balance as payrolls of these governments expanded at a faster pace in July and August. A lot of this was make up for many months of decline in the Q2. The international trade deficit widened in June before narrowing substantially in July. This is because of China, and of course the Import-Export Bank at this stage of the game will not be renewed. Total U.S. consumer prices, as measured by PCE index, edged up 12 months ending in June, restrained importantly by declines in energy prices. Now those energy prices have sort of rebound. Core PCE prices, which exclude food and energy, increased 1.14% over the same period, with increase dampened in part by declines in price of non-energy imports. Measure of labor compensation rose faster than consumer prices over the past year, but the modest increase in compensation were similar to those in recent years. Over 4 quarters ending in Q2, the employment cost index increased nearly 2% in compensation per hour in non-farm business sector, 2.25% over 12 months ending in August. Average hourly wage for all employees or workers increased 2.25%. Foreign growth remains weak in Q2, held back by contradictions in real GNP in Canada, Brazil, in Taiwan, of all things. Activity continues to expand at modest pace in the Eurozone and the UK. Indicators from Q3 point to slight pickup in pace of foreign growth. Canada suggests that the same first half weakness in it's more petroleum dependent in Canada. Not very good there. However, recent indicators from some other countries, notably China, subdued inflation rates continue to be quite low in advance of foreign economies. In the advanced foreign economies, market-based measures of inflation compensation have recently moved down in the Eurozone and Japan. Let me move along here. Staff review of financial situation data released met market expectations. Domestic financial conditions tightened modestly as concerns about prospect for global economic growth centered on China. Over the intermeeting period, the concerns about global economic growth and turbulence in the financial markets led to greater uncertainty amongst market participants, and the likely timing of a start of normalization stance on a monetary policy based on federal funds future. The probability of first increase target rate was in at the September meeting. Fell slightly. The probability attached to subsequent meetings through January of 2012 was generally little change, and rose for meetings later in the year. Similarly, participants from the DES September survey of primary dealers and survey of market participants indicated on the average respondents pushed out their expected timing of first increase target for federal funds rate. Regarding the most likely meeting date for the first increase, survey respondents evenly split September or December. Well, it won't be September and perhaps not December, despite the decline in global equity markets and downward shift in expected path of the federal fund rate. Yields on normal Treasury securities moved up modestly in some markets, citing proposed sale of Treasury securities by foreign governments. Broad U.S. equity pricing index were higher